Today, we are going to discuss the collapse of SVB Bank, a bank in the U.S. top 20 with over $200 billion in total assets. This bank was a close friend to the tech industry, yet it evaporated as quickly as cash in your wallet at the end of the month. So what exactly happened? Also join the Fuqbao community group, which is great for those who want to learn and know more about the crypto industry. The link is in the description and comments. It shows a very specific customer segment: tech startups, venture capital funds, and companies in the healthcare sector. This is called a niche market. Instead of selling to everyone, SVB focused only on the demographic they wanted. For example, if William opens a clothing store, instead of selling every style, he focuses only on the niche customer interested in luxury vintage fashion. Back to the bank. Traditional banks were hesitant to lend to startups because they could fail at any moment. According to my sources, SVB once served nearly half of all venture capital-backed technology and healthcare companies in the US. For many, having an account at SVB was a symbol of credibility, a badge to enter the elite tech community. Transactions between startups here were fast and efficient, creating a tightly integrated, closed financial ecosystem. You could say the SVB brand was not just a bank. It was part of the DNA of Silicon Valley. During the peak of the COVID-19 pandemic, the global economy slowed, but the tech sector exploded. Venture capital funds poured money into the market, and that cash was stored and transacted through SVB. In a short time, deposits at SVB skyrocketed from $60 billion in Q1 2020 to $189 billion by the end of 2022. They made a decision that sounded very rational. Instead of lending to high-risk startups, they played it safer. Exactly, worse than SIF, they bought long-term government bonds and mortgage-backed securities houses. These are considered the safest assets in the world, but they were safe for the general public, not for SVB. SVB collapse revolves around two core concepts: interest rate risk and duration mismatch.
This caused bond prices to plummet, as investors preferred buying newer bonds with higher yields.
SVB had bought many bonds when rates were low, so those bonds were now deeply undervalued. Simultaneously, their core customers, the startups, were no longer receiving new VC funding. They had to withdraw their deposits to stay operational. Gators. SVB was forced to sell its bonds, but since they bought high and the prices had dropped, they realized a huge loss. This loss amounted to $1.8 billion. SVB tried to raise more capital to cover the loss, but this announcement caused investor panic, leading to a massive wave of withdrawals. SVB tried to raise more capital to cover the loss, but this announcement caused investor panic, leading to a massive wave of withdrawals. Next, let's talk about duration mismatch. This was the core and most serious error. The money customers deposited was short-term. They could withdraw it at any time, a week, a month, even a day. Yet SVB used that money to invest in long-term assets like bonds, intending to hold them for 5 to 10 years before selling. A massive, short-term, easily withdrawable fund from startups, but used it to buy long-term bonds, assets that would incur a loss if sold immediately. Fed's actions caused two severe consequences. First, the value of the long-term bonds held by SVB plummeted significantly. Higher borrowing costs made venture capital funds and startups struggle, and the tech winter arrived. Investment funding for startups dried up, forcing these young companies to withdraw their deposits at SVB to sustain operations and pay salaries. So, the fateful sell-off event arrived. Facing increased withdrawal demand, SVB realized they lacked sufficient cash on hand. On March 8, 2023, in a desperate effort to raise capital, SVB announced they sold $21 billion worth of securities. The bank also announced plans to issue $2.25 billion in new stock to strengthen its balance sheet. SVB could have handled the loss discreetly, but the public announcement sounded like a confession. We are in trouble. When there are rumors of a bank's weakness, fear spreads. When everyone believes the bank is about to collapse, they all rush to withdraw their money. One day, March 9, 2023, customers withdrew a massive $42 billion, nearly a quarter of the bank's total deposits. While a traditional bank run involved long lines outside a branch, the SVB bank run was ignited and spread across social media. This was the first bank collapse in history to be publicly driven and coordinated through Twitter and private investor chat groups. The high cohesion of the startup and VC community, which was once SVB's strength, suddenly became its fatal weakness.
As influential investors tweeted and shared withdrawal information, fear spread at the speed of a virus. Messages like, pull your cash out.
Bank run takes weeks to unfold. But the SVB bank run was over in just 48 hours.
Another founder, Quincy Lee in Seattle, tried to withdraw millions, but the bank's website was already overloaded.
He had learned about bank runs in university, but never thought he would live through a real one. At that moment, the risk of SVB's failure was 99.9%. The remaining 0.1% depended entirely on government intervention. When a bank collapses, the Federal Deposit Insurance Corporation, the U.S. government's cleanup crew, appears. The FDIC mechanism is simple. It insures deposits up to $250,000 per depositor per insured bank. However, with SVB, things weren't so simple. Less than 15% of total deposits at SVB were insured. SVB's customers were mainly startups with millions, even hundreds of millions of dollars needed to run the company and pay salaries. Exceeded the FDIC's insurance limit, meaning the FDIC alone couldn't prevent SVB customers from losing all their money. The U.S. had a strategic view. Instead of just worrying about banks being too big to fail, as in 2008, the government faced a new threat.
SVB was only a mid-sized bank. It was the financial hub for an entire tech ecosystem, including thousands of startups and VC funds.
If SVB had collapsed, it wouldn't just have harmed one bank. It could have crippled an entire vital economic sector. The collapse of SVB certainly holds valuable lessons for us.
The first and most obvious lesson is, don't put all your eggs in one basket.
That SVB was overly concentrated on a single customer segment, tech companies and startups. When that sector struggled,
the double-edged sword of specialization. The price of not diversifying your customer base is collapsing when your niche faces problems.
Banks typically use derivative tools to hedge and protect themselves, like buying insurance for assets. Studies show that SVB failed to do this adequately. Or meant you to do this adequately. The fallout from the SVB incident spread beyond the U.S. borders.
But who knows? This is not the only bank collapse in the last 1,000 years. Only thing that sting Tresley to grouse. The only thing that never changes is human nature. In the European context, experts noted that the direct impact was not large. However, the event could indirectly affect the startup ecosystem. Some US VC funds with deposits at SVB became more cautious and could slow the pace of funding for new projects across Europe. And could slow the pace of funding for new projects across Europe. The incident showed that mid-sized banks with unique risk structures, like SVB, still pose a severe threat to the entire global financial system.
That is what I felt needed to be said about the collapse of SVB Bank.
What do you folks think about this event? And did I miss anything? Let me know below. I am William. Leave a thought. Am Lurie. F for birds. Don't forget to subscribe so you don't miss any video.